Hi guys, so for today's video we're going to be looking into sweeps, an insight into sweeps, otherwise known as liquidity hunts, stop runs or swing failure patterns. The content of this video will include common logic and personal rationale, context, and finally confluence and execution. So let's start by understanding there are market participants of all sizes, from entry-level retail traders to large and established market participants. For the entry-level participants who trade with small size, the only disadvantage of entering via a market order is the taker fee incurred. For large participants, this is not the case. If they were to enter a trade by market, they would incur both the fee to do so as well as slippage on their order as they eat through the available liquidity on the order book. The bigger the intended position, the larger the slippage, of course dependent on the liquidity of the market in question. Let me explain this as simply as possible. Asset A is currently trading at $100. At current, there are 1 times A at each price point, and for the purpose of this basic example, Asset A only trades in whole figures, no decimals. So there's 1 times A for sale at 100, 1 times A for sale at 101, 1 times A for sale at 102, 1 times A for sale at 103, and so on and so forth. Let's say the small retail trader wants to buy 1 times A. They can do so at market at the price of 100, as there is 1 times A available in the order book for them to buy at that price. If, however, the large participant wants to buy 10 times A and buys at market, they will end up buying at all price points from 100 up to 109 in order to get their fill of 10 times A. The small participant has an entry of 100, whilst the large has an average entry of 104.5. So, from the get-go of these positions being taken, the small participant has a much better entry than the large, who has experienced slippage on their entry. Now, this unfavorable method of entry is not how large participants want to operate, so how do they get around this? Well, they need to conduct business at areas of higher liquidity on the opposing side of the trade, okay? In short, to buy a large amount, they need to be operating in an environment where there are an abundance of sellers, or to sell a large amount, they need to operate in an environment where there are an abundance of buyers. Now, let's take a look at what hard stop losses are. They are orders most often in market form that are executed as the reverse of the current position type in order to get out of an existing trade. This means if you are long, you need to sell back your position to close the trade, and if you are short, you need to buy back your position to close the trade. Stop losses are normally placed at the level of invalidation for the trade, which tend to be either key highs or key lows. Even if the trader isn't well versed in understanding invalidation, these highs and lows are natural places for new traders to gravitate towards when executing stop placement, with the rationale of I'm short and wrong above this high, or I'm long and wrong below this low. As a result, these points on the chart experience a build-up of liquidity. The notion of stop hunting is based around the premise that for our large participant to get their fill, they need to firstly push price towards these points, then stop out a number of traders, collect liquidity from their stop losses, and then finally reverse in their direction of intent. So let's take a look at an example on the chart. So we're just going to take a look at current BTC price action because it's just been sweeps on sweeps on sweeps recently, so a good time to look at things. Okay, so here we are, sideways price action, bracketing, ranging environment, very choppy, very curled up, very tight. Not a great place to be trading unless you're an active scalper. Let's see what happens next. Right, so price moves to the downside, sharp impulse. We can also see that there's a bullish divergence here. If we pull the RSI up, there it is there, okay? So let's say that we have a trader that takes a long position here. Just gonna mark on that entry. Okay, so let's say they take long here. So entry in green, and then they place a stop underneath the lows. They're not very confident in this trade. They don't want a wide stop. They want to protect themselves from further downside, and they're also seeing that there's a lower time frame triple drive in here along with a 30-minute div. They want to see price move up from here, or their trade thesis is invalidated. So they put a stop at the lows here, Right, so at this point we have one trader in a long position with a stop at the lows. Okay, we're just going to fast forward just a little bit. Okay, so let's say another trader was looking at this consolidation here, right? They see this impulse start away. As it starts moving to the upside, they take a long position here as well. This trader also wants to have a stop at the lows. They're trading based on a more higher time frame level. They put their stop there as well. Okay, I'm just going to put it just underneath so we can see it visually. Right, I'm just going to fast forward a little bit as well. So we've just fast forwarded a little bit. Okay, so let's say that another trader who isn't actively in a position is now looking at the markets, sees this huge sell-off, thinks it's extremely oversold, wants to long as well. So we have a third trader taking a long position on this candle close, for instance. And they also want to put their stop at those lows as well. Right, so you can see what's happening here, right? You've got multiple traders following price action, all in 3 separate trades, but they all have stops at exactly the same point here, okay? So let's just fast forward again. Price chops around, starts coming down. More chop, further down, and stops out all 3 traders here, okay? So, for the argument of this demonstration, we had 3 traders in long positions. Now, imagine the same scenario with an extremely high magnitude of long traders, all with their stop at that key low here. If the large player was seeing the market move, say at this point here, and decided they want to get long on the market, but at this point in time and positioning, there wasn't sufficient liquidity for them to enter into a long position, they would push price down to the level at which they believe stops were resting at, down at the key low. Now, to run through what we already covered again, a stop for a buy or long is a sell. So, if our large participant moves price down to that level successfully, he's essentially interacting with a bunch of sellers who he or she can buy from. Okay, so now we just dial down to the lower time frame, here looking at the 15-minute. So you can see here, this is the low that ran the stops for the previous example. And we can basically just play this over and over. So let's say someone takes a long position here, thinks this is an extremely oversold move. Okay, so let's just plot their entry there. Stop at the lows. Okay, so we have one trader long. Price moves nicely in their direction. So let's say that once we move past this level of interest supply, another trader goes long here. Okay. So we'll just plot their entry there. Also put their stop at the lows. Right. Price carries on. Let's say a third and final trader enters here, whatever reason they have. Stop at the lows. Okay. Now we're just going to fast forward a little bit and see what happens. So price is chopped around considerably here. We have some nasty whipsaw action. Then it goes down, collects the stops once again. So let's say at this point, the large participant has now had their fill. They do so down here in the blue box, right? And they now intend to push their position to the other side of the range high, okay? And at that point, they'll start offloading their position, right? Price moves up, carries on, and here, okay? So they've taken their move down from the lows here, this key low, back to the range high for a 7.5% move, okay? So now they're out of the trade. So I just wanted to go through a couple of examples to show you the theory in real time and why the notion of stop hunting, so to speak, has its foothold set in trading theory. But I want to point out that this school of thought that there are large participants manipulating price to key highs or lows is simply just theory, right? Others argue that these patterns are simply lack of momentum and that when price attempts to break out, whether up or down past a key high or low, there simply isn't enough drive from buyers or sellers respectively, and as a result, price reverts in the opposing direction. Although I thought it important to go through the different theories on why these patterns occur, the only thing of importance, in my opinion, is the notion of breakout traders. What do I mean by this? Well, let's look at the current example to demonstrate. Right, so here's what happens. Breakout traders short the break of lows or long the break of highs into a passive market participant that absorbs their orders in the form of limit orders before reversing in the opposing direction, putting them offside on their trades that they later unwind to fuel the move. These are known as trapped traders, and we'll cover these off later down the line, especially once we start moving into the order flow side of things, where we harmonize these basic price action concepts with footprints and other tools that give us high levels of detail. Right, so back to the chart now for an example. This was the price action we were looking at earlier. So as we know, price moved down, as we saw before. As we approach the low, a large number of breakout traders start hitting market sell, but they do so unknowingly into a passive market participant with a heavy layer of bids just underneath this low. Price breaks down into the bids, right? Their sells are absorbed, and then price goes on to reverse in the opposing direction. So this is the tangible argument for sweeps and can be visualized through order flow, where, in this case, you'd see a high level of negative delta. And that means that lots of market selling occurred into these lows, and without price successfully breaking down, and in fact doing the opposite, those sellers are now offside and their efforts did not trump the passive participant, okay? So as price continues back up here, they panic exit their sells, and to do so, buy back their position, which adds to the drive back up. Okay, so now we're moving on to our next section, context. So we'll be looking at marking targets, local versus historic sweeps, and then pro-trend versus counter-trend applications. Okay, so I know it's blindingly obvious, but for the sake of covering all bases, I just want to talk about marking targets. So you're looking for key highs and key lows, which are points in the chart that stand out as clearly defined tops and bottoms, okay? These are areas that now stand as key levels, and as a result, are points at which price could or could not break out. And going back to our last example on breakout traders, we already understand the significance of that premise, right? So here's a key low. Here's a key high. So these are sort of levels we want to mark out as our target levels, yeah? We don't want to be marking this low here or, these lows in here. That's not what we're looking for. And vice versa, we're not looking for these choppy highs up here. We're looking for the key lows and the key highs, okay? Now onto the differences between local sweeps and historic sweeps. So yes, we are typically looking for key highs and lows that were set some time ago in the past, which would be a historic sweep. But you also get local sweeps, okay, where price fails to make a new impulse and sweeps the last local high or low before failing. So we can see an example here. So high was made here, okay? Price tries to make a new impulse up, fails, sweeps, retests, and comes down, okay? So this would be a local sweep versus this, which is a historic sweep, okay? Something that happened quite a while ago. We're coming down, sweeping the level, and coming back up. So now on to pro-trend versus counter-trend applications. Here we have two examples, both within the same range. One is counter-trend, the other is pro-trend, okay? So what defines these? Well, if we look at how price entered the range here, we can see that it was an impulse down into the current range. So this here would be a counter-trend sweep, right? Whereas this would be a pro-trend sweep. So pro-trend sweeps, when coupled with good order flow, are really good entries. And although counter-trend sweeps can of course play, they obviously bear higher risk, all right? So as with all the techniques I'm teaching you, I would advise you focus on pro-trend applications as your primary triggers, especially for beginner traders. Okay guys, last section for this video, confluence and execution. So we'll be looking at execution types, aggressive versus conservative, candle closes, oscillator overextensions and divergences, a note on order flow, and lastly, stop placement. Okay, so before we get into this, I want to say off the bat that this video is only covering price action concepts, and there will be some guidance here on execution, but my primary tool for execution is order flow, which I'll cover in a couple videos time, so make sure to sub, keep notifications on for that as it will be coming up soon, all right? Right, so there are two execution types, aggressive and conservative. The most aggressive approach will be placing blind limit orders at the lows or highs. I don't recommend this unless price is hugely overextended as it reaches the level. That's something we'll cover again in a later video, but the speed at which price approaches levels is incredibly important and rarely spoken about. The most common method and the more conservative is entering based on candle closes. Now, there are two ways to do this. Either wait for the candle close on the respective time frame you have drawn your level from, or take closes with installments based on different closes from low to high, such as say 25% on a 5-minute close, 25% on a 15-minute close, 25% on a 30-minute close, and the last 25% on the hourly close. Again, this is up to you guys to play around with, as these are only price action only strategies and dependent upon your personal risk parameters. Okay, so now to talk about candle closes in a bit more depth. Technically, for these patterns to be considered sweeps and not deviations, you want to see the wick below and the close above, like you have here, okay? Wick below, close above, and vice versa for a sweep of the highs. That being said, I'd urge you to not lend too much credence on this, right? The important thing is what happens as price takes out the level. Does it break out or does it revert? So here it hasn't broken out, it hasn't broken down, it's reverted, okay? So that coupled with footprint data, which we'll dig into later, are much, much more important than closes, which are essentially just time-based and arbitrary in nature. What I mean by this is that a 5-minute close past the level and back up again could easily be a 15-minute candle with a wick below and a close above. One piece of alpha I will impart in this video, however, is to focus on oscillators, both in terms of overextensions and divergences. If you can get a divergence into the level, then that's great. Here we actually have an example of this. So if we get the RSI up, so there's a lower time frame bull div here, flat bottom bull div on the 5-minute. As price takes out the level, then we get the green bar closed to confirm the divergence, okay? So if we just draw this on, that's the div there. Okay, so comes down, sweeps the level, closes above, green bar close, locks in the div. Okay, and we can see how fruitful this was later on down the line, okay? Huge impulse to the upside. So getting into overextensions, you want to see as many time frames overextended as possible on the RSI, meaning out of this blue zone here and into the white zones, or otherwise below 30 or above 70, okay? I'm primarily looking at the 1 hour and below, but anything above, such as the 4, 12-hour or daily, is of course very welcome. So here we have a 1 hour sweep of the lows, so here we have an hourly sweep of historic lows. You can see the RSI is just about overextended below the 30 mark. So that ticks the box there for the hourly. Now go to the 30-minute, we can see, yep, just below the 30 mark at about 28.5. The 15-minute again, slightly lower down, 25s. 10-minute is starting to get more overextended here at 24s. Now we get to the 5-minute and you can see really how overstretched it is down here at 18. 3-minute again, even more so, 15. Let's have a look at the 1-minute. So this is an interesting picture here on the 1-minute. We actually have a bullish divergence here on the minute. We can see that the RSI here is making a higher low, whilst price makes a lower low. So In fact, this trade would be a sweep of a historic low overextended on multiple time frames with a lower time frame or 1 minute divergence as additional confluence. Okay. So to cover off, guys, just to note on stop losses, if you want to use a hard or market stop, I would always err on the side of caution and place a wider stop, not directly at the wick of the sweep, as price can of course come down or up to double or in some cases triple sweep before going in your direction. You have to play around with it, but something I've found is that if you do want to try tightening up your stops, it's better to do so on lower time frame sweeps. I found that they normally tend to either sweep and go in your favor, or if not, come back and invalidate your trade, whereas higher time frame examples can sweep a historic level, move in your direction, and when you think everything is going as planned, it will execute a local sweep of that historically swept level. This trade trigger is called an LSO or local sweep of historic, and is a particular trade that I'll go into in more detail in following videos that are more specialized in particular trade executions rather than just general theory. Okay, so you can see that play out here. Price sweeps the historic level, goes down for a couple of days, and then comes up to take that level out and double sweep before dropping. So again, just be cautious with your stops and understand that sweeps can go back for nasty double or triple sweeps in themselves, okay? Right guys, so that's it for today's video. Hope you garnered some useful information from the content. Make sure to like and sub, and I'll be sure to put out some more content soon.